When oil pushes back toward $100, AI leaders wobble, and rate hike odds jump, equity markets have to rethink risk very quickly. Welcome to vTalkInsight, Equity Pulse Daily for July 27, 2026. Today we connect the energy shock, shifting central bank expectations, and the reset in big tech leadership to see how the equity backdrop is evolving into the Federal Reserve decision and a heavy earnings week. The macro picture is now dominated by an energy shock layered on top of already tight financial conditions. Brent crude has surged more than 30% this month and is hovering around $100 a barrel, while West Texas Intermediate has jumped from $70 to $90, driven by disrupted flows through the Strait of Hormuz and the Red Sea. Refined products look even tighter, with diesel prices up about 10% since early July, U.S. refineries running at roughly 96% capacity, and strategic reserves drawn down, leaving far less buffer if tensions escalate. Geopolitics are firmly embedded in that oil premium. Threats to key choke points like Hormuz and Bab el-Mandeb, talk of potential U.S. strikes on Iranian targets after recent casualties, and internal divisions within Iran's leadership all point to a persistently elevated risk premium for energy infrastructure. Europe is particularly exposed, facing years of structurally higher energy costs as it competes with Asia for gas supplies, even as recent purchasing managers' indices for Germany and the wider euro area have crept back above 50, signaling tentative growth momentum against a stagflationary backdrop. For central banks, that mix of firmer growth and renewed inflation pressure is making decisions harder. Federal Reserve officials are increasingly focused on the inflation impulse from higher energy, new tariffs, and surging AI-driven demand, and market pricing now leans toward 2 rate hikes by January, even as many economists still expect no further hikes and a cut down the road. 10-year yields have pushed to around 4%, equities and bonds have already suffered a correlated risk-off day, and an equity volatility gauge has moved back toward the high teens, underscoring that the policy debate is feeding straight into cross-asset repricing. Trade policy is adding another layer of complexity. The U.S. has rolled out fresh tariffs of roughly 10 to 12.5% on goods from around 60 economies, with robust legal underpinnings and the possibility of further Section 301 investigations that could push some rates much higher, especially in politically sensitive sectors like generic drugs. While current tariff levels are not seen as a dramatic new inflation shock, they reinforce a deglobalization trend that raises structural costs and supply chain friction, even as hard data show no U.S. growth scare and euro area business surveys climb back into expansion. Against that macro backdrop, the equity tape looks more fragile beneath the surface than headline indices suggest. The S&P 500 has just logged its worst single day in about a month, and yet there are sessions where the index finishes roughly flat because losses in a handful of large technology names offset gains in most other sectors. That pattern underlines just how dominant mega-cap tech remains for index-level returns and how quickly broad risk sentiment can shift when those leaders come under pressure. Leadership is already rotating. Real estate recently led the sector performance table with a gain of more than 2%, while information technology was the only sector in the red, falling close to 1%, and flows continue to move toward areas like energy, industrials, financials, and healthcare. Recent declines in equities look more like capital being reallocated away from highly concentrated tech positions than a wholesale rush for the exits, even though the average stock sits more than 18% below its one-year high. Valuations have adjusted meaningfully in the technology complex. The sector price-to-earnings multiple has fallen from roughly 32 times to around 23, and its premium over the broader market has narrowed from about 45% to around 10%, while semiconductor stocks, which rallied roughly 80% over the past year, have cooled and now face record high implied volatility into earnings. AI-related stocks are down 15 to 20% from recent peaks, and the so-called Magnificent Seven have collectively shed close to $1 trillion in market value in 1 week, signaling that markets are no longer willing to capitalize AI stories without clearer profit trajectories. Yet the broader risk appetite picture remains more constructive than that rating might suggest. ETF demand is robust, with roughly 9 new products and about $9 billion of inflows each day, even as closures speed up and the stigma around shutting down small funds fades. And investment-grade companies have raised more equity capital this year than in any year since the financial crisis, largely to fund growth rather than plug balance sheet holes. A strong pipeline of initial public offerings, including around 50 prospective listings on Singapore Exchange, and a heavy slate of private equity-backed deals globally, plus upcoming earnings from companies like UPS, PayPal, Ford, Visa, Apple, Amazon, Chevron, and ExxonMobil, all point to an equity market that is rotating and repricing, but still willing to fund credible growth stories. The AI Capex supercycle has now become a macro variable in its own right. Capital spending plans by large cloud and data center players are now expected to exceed $1 trillion, up sharply from earlier estimates closer to $750 billion, and that investment is colliding with higher energy prices and new tariffs to create a more persistent inflation backdrop. Federal Reserve officials are explicitly flagging AI-driven demand as one of several upside risks to inflation, even though market-based long-term inflation expectations remain relatively well-anchored. Equity markets are starting to challenge the earlier phase of AI euphoria. Major U.S. technology groups such as Google and Tesla are seeing free cash flow squeezed or turn negative as AI-related capital expenditures surge, and the recent 15 to 20% drawdown in many AI names, alongside the sharp loss in value for the Magnificent Seven cohort, shows investors are no longer willing to pay up purely for scale and narrative. Market participants are becoming more discerning among systemically important tech names, with some arguing that recent weakness could be a long-term opportunity, but also acknowledging that meaningful returns from current AI data center spending may not be visible until around 2028. Credit markets are echoing this shift in tone. Roughly $219 billion of technology debt has been issued this year, much of it tied to AI infrastructure, and an increasing share of that Capex is being funded by borrowing rather than internally generated cash flow, with some bonds now trading below par. Spreads on AI-exposed issuers are widening as investors demand higher yields. Deals such as recent offerings by Meta and Amazon are attracting less oversubscription than in past cycles, and early signs of stress are appearing in the investment-grade market as investors question whether the returns will justify the leverage. Within this more cautious framework, markets are rewarding AI stories that pair growth with clearer monetization and risk control. Companies like Intel, which is seeing strong demand for AI-capable CPUs, and SAP, which is reporting faster than expected growth in AI-enabled cloud services, are being differentiated from more speculative exposures, while Amcor's double-digit share price jump on an AI platform partnership with NVIDIA highlights the appeal of tangible, revenue-linked collaborations. At the same time, rapid deployment of AI agents into core operating systems is raising systemic cybersecurity and regulatory risks, prompting a surge in corporate spending on AI safety tools and reinforcing the idea that future policy choices in the US and Europe could become a key driver of tech sector valuations. Recent company reports put more texture around this top-down story, starting with semiconductors. Intel's latest results showed a revenue forecast well ahead of expectations, powered by robust data center demand as AI workloads shift from pure model training to broad-based deployment, prompting the company to raise its 2024 capital spending plan from $18 to $20 billion and lifting the share price by about 4%. Analysts at JP Morgan have significantly increased their price target, citing Intel's strengthening turnaround, its growing foundry business, and its unique status as the only US-based leading-edge chipmaker at a time when geopolitical risk around Taiwan is pushing customers to diversify manufacturing. Even as some equity investors worry that higher Capex and potential equity issuance could weigh on future returns. Enterprise software and energy services are sending similarly nuanced signals. SAP delivered stronger than expected second quarter cloud revenue and bookings, with clients increasingly opting for its AI-integrated solutions over generic models, driving nearly a 5% jump in the share price and sparking a relief rally in European tech after a period of weakness. Results from S&P and RingCentral also beat expectations, with RingCentral surging around 25% on heavy volume despite a large short interest, while SLB reported double-digit gains after an earnings beat driven by broad-based international revenue growth that more than offset Middle Eastern weakness linked to regional conflict, underscoring how resilient execution can cut through macro noise. The auto and consumer complex illustrates the growing divergence in end markets. Volkswagen has slashed its full-year revenue guidance from modest growth to as much as a 3% decline after a 37% drop in second-quarter deliveries in China and ongoing problems with costs and software, while management acknowledges a roughly 30% overhead gap that may ultimately require tough restructuring in the face of political and union resistance. By contrast, Tesla's share price has come under pressure as AI spending hits margins, but the company is leaning into its identity as a physical AI player, highlighting record energy storage deployments in Europe, the Middle East, and Africa, and positioning its battery and autonomy efforts as infrastructure that could benefit from the same AI and energy transition themes reshaping the broader market. On the consumer side, American Express reported 10% revenue growth and a 9% increase in card spending alongside stronger guidance and excellent credit quality, but the stock still slipped on softer fee income, suggesting that while higher-income households remain robust, markets are finely tuned to any sign of revenue mix pressure. Lower-income-focused retailers such as Albertsons are having to sacrifice margins to hold down prices as tariffs and energy pass through into household budgets, even as scale players like Walmart and Amazon use technology and supply chain advantages to consolidate share, and UK retailers attract fresh interest after better-than-expected retail sales data. Beneath that, structural shifts continue. U.S. battery manufacturers are building over 100 gigawatt-hours of new capacity and pivoting away from Chinese graphite, with firms like Sila Technologies raising hundreds of millions of dollars to move from a few to tens of gigawatt-hours in production. While real estate shows resilience through U.S. housing demand, Austin's zoning-driven rent declines, European property M&A, and a strong pipeline and rising derivatives volumes at Singapore Exchange, all of which sit alongside SpaceX's high-stakes pivot from Falcon 9 to Starship, a move that concentrates launch risk for satellite and telecom customers if Starship's timeline slips. Stepping back, the equity market is balancing a powerful combination of forces: an energy shock that risks reigniting inflation, a Federal Reserve and European Central Bank that are leaning more hawkish even as growth data surprise on the upside, and an AI Capex cycle that is moving from euphoria to a more demanding phase where cash flow and credit quality matter as much as narrative. Index-level moves may look modest on some days, but beneath the surface leadership is rotating away from the most crowded mega-cap tech exposures toward a broader mix of real estate, energy, industrials, financials, select software, and companies tied to the energy transition and supply chain rewiring. From here, the key things to watch are the Fed decision and surrounding communication, the path of oil and refined products through the next leg of Middle Eastern tensions, the tone of earnings and guidance from the remaining global tech and energy majors, the behavior of credit spreads around AI-linked issuers, and whether semiconductor results can clear a very high volatility bar. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.